Good afternoon, everybody. My name is Gstädtner. I'm president of the EBI, and I would like to welcome you to our EBI policy series today. It's about the CRR review and update on the outcome. It's about to be finalized these days. It's been quite long in the making, I would say. I mean, it has been approved in Basel in 2017 and the whole package. And since then, obviously, many things have happened. There was a COVID pandemic. The war of Russia against the Ukraine has started. And obviously, as a consequence of many of these events, also we had a different economic environment and inflation is higher. The economic environment is difficult right now. But the European Parliament now is about to approve the final package. It's now having a different name. I think it was called originally Basel IV, but now we're talking about the Basel Endgame, which is about to be approved these days. And I'm very happy that we have Markus Ferber from the European Parliament here, who has been key and instrumental in negotiating this package, who's giving us an update about the latest developments, about the key provisions in that regard. Markus, welcome to you. And then I also would like to welcome Christian Castro, Head of Public Affairs at CaixaBank. Christian, welcome to you as well. And then Professor Bart, Joosen, Professor of Financial Law at the Leiden University and member of the Academic Board of the EBI. Before I go into detailed details of your CVs, maybe just a quick overview about some points that we're gonna talk about. The Basel framework basically introduced various changes to the existing framework. So the credit risk framework is about to be changed. The market risk framework is seeing some fundamental changes with the fundamental review of the trading book, which is about to be implemented. Overall, there will be an introduction of an output floor, which we will also touch upon today. Op risk will be changed, and then will be new provisions regarding ESG, so environmental, social, and governance standards, which will be introduced also into the new framework of the CRR. And finally, a point to mention is also new regulations regarding third-party branches. Maybe then a quick introduction of all our speakers. Markus Ferber is a member of the European Parliament. He's a graduate engineer and is representing Swabia, so a district in Bavaria, in the European Parliament since 1994. So a very long member of the European Parliament already. He's a member of the Economic and Monetary Affairs Committee and an alternate member of the Transport and Tourism Committee. Markus Ferber is spokesman of the Parliament for the Parliamentary Group for Small and Medium-Sized Enterprises and coordinator of the European People's Party Group in the Committee on Economic and Monetary Affairs. Since 2020, he has been chairman of the Hans Seidel Foundation, and in July 2021, he was elected vice president of the Union of European Federalists. Thanks very much again, Markus, for coming and joining us today. Second, I would like to introduce in more detail Christian Castro. I mentioned already he's head of public affairs at CaixaBank, where he coordinates and contributes to the development of policy proposals of relevance for the group, especially on regulatory matters. Prior to this position, Christian was head of the division on global prudential policy and impact analysis at the Banco de España, and previously to joining Banco de España, he worked also for the Bank of England as a PhD economist in the Prudential Policy Division. At present, he's a member of the Coordination Committee at the European Savings and Retail Banking Group, chair of the ESBG Task Force on Basel IV, and member of different working groups on regulatory issues at the ESBG and the Institute of International Finance, IIF. Christian holds a PhD in business economics from the University Autònoma de Barcelona. So welcome again, Christian, and thanks for joining us. Last but not least, Professor Bart Joosen. He's well known in the EBI. He was once also the academic president and is working at the University of Leiden. He's trained as a civil lawyer at Tilburg University. He obtained his LLM degree in 1987. After completion of his academic study, he was appointed as lecturer in the law faculty of Tilburg University in 1987. He works since 1992 in private practice, particularly for financial markets clients. His main area of expertise are in the field of financial services supervision, with a focus on macroprudential supervision of banks, insurance companies and investment firms and payment services. So Bart, thanks very much again for joining this event. And then without further ado, I would like to hand over to Markus for his keynote opening speech. And then afterwards, we will have the chance also with Christian and Bart replying to that. Markus, over to you. Thanks very much.
Yeah, thank you very much, Thomas. It's a great pleasure being here, and thank you very much for the kind invitation. Today's session comes to a perfect moment. I'm connecting to you from Strasbourg today, as the European Parliament has its last plenary session of this legislative term this week. And one of the many agenda items we will be voting on and debate, of course, is indeed the Basel III finalization package. So therefore, we are just in time. Tomorrow we will have the debate and the vote. This might be a little surprising, as the interinstitutional negotiations were already concluded in June last year. And while the political and administrative processes in Europe can be slow from time to time, it usually does not take 10 months to go from the political agreement to the final plenary vote. So what has gone wrong this time around? Well, to put it simply, the trilogue agreement turned out to be a bit premature, and not all of the points that should have been solved on political level had actually been solved, or some member states still thought it's not yet solved. Before I go into the details of the trilogue results, though, let us take one step back and revisit what the key challenges with the Basel finalization package have been. As we all remember, the final deal on the Basel III finalization package in the Basel Committee was struck in December 2017, so a long time ago. So it has taken us quite a while to get this over the finish line. And if I look to other jurisdictions like United Kingdom or the United States, we are not even the lazy bones. We are still the front runners. The biggest reason for the quite substantial delay has, of course, been the COVID-19 pandemic, which also delayed the Commission proposal for the European implementation by quite a bit. From the very onset, it was quite clear that the Basel III finalization package was a compromise that was not necessarily ideal for the European banking sector. And that is one of the things we have to discuss somewhere else, how Europe is representing itself in international bodies like Basel. I believe it is fair to say that the final deal was something that was a much better fit for the US banking system than for a European one. This arguably raises fundamental questions about the Europeans' delegation negotiation strategy, but as I said, that is a different matter. Anyway, the damage was already done in 2017, and everything from here was damage control to a certain degree. If that is the benchmark, then the Commission proposal was already a useful starting point. So what are the big changes in the banking package? So I start with output floor, which you have mentioned already, Thomas. The most widely discussed amendment of the CRR 3 proposal, and you know we translated in CRD directive and Capital Requirements Directive and Capital Requirements Regulation, CRR, CRD, and we count them. So Basel III is not directly linked to our numbers, but CRR 3 is still in line, is the inclusion of a lower bound on banks' capital requirements when banks use the internal rating-based approach, the IRB approach. The guiding idea was that bank supervisors saw a lot of variability in how banks applied their internal models and what they would mean for capital requirements. Arguably, that raises level playing field issues and also concerns about possible underestimating certain risks. So the idea was to make sure that internal models cannot become too aggressive by setting a minimum floor. The output floor is set at 72.5%, which was a mathematical method to achieve this figure, of the own funds requirements that would apply based on the standardized approach. That output floor will be gradually phased in over a 5-year period from 2025 to 2030. Then we had another big issue, and you mentioned already my responsibility for small and medium-sized enterprises. and that was the question of unrated corporates, which is fully different landscape in the European Union in comparison to the United States of America. The new methodology has also particular implications for the corporate lending. Institutions using internal models for their unrated corporates will now also have to calculate capital requirements through the standardized approach. The standardized approach for credit risk requires the use of external ratings to determine the credit quality of the corporate borrower. If there is no rating, a standard risk weight of 100% applies. That is, of course, a big problem for companies with high creditworthiness, and that would otherwise benefit from a lower risk weight and more favorable financing conditions. This provision is a big problem for the European market. As I said, most European companies are not rated nowadays. This is a big difference to the United States. However, the impact might be very detrimental, as financing costs for European corporates could suddenly balloon, although nothing has changed in terms of their creditworthiness. To lessen the impact of that provision, the European legislator agreed on a dedicated transitional agreement for unrated corporates. Banks will be allowed to apply a preferential risk weight of 65% to their exposure to corporates that do not have an external rating. This is subject to the condition that those exposures have a probability of default or less equal to 0.5%, coinciding with an investment grade rating. However, this is only a transitional arrangement and will only be in place until the end of 2032. Though the blow has been softened, but the problem is not solved. It will be very important to make good use of this transition period in order not to face a cliff edge scenario in a few years' time. I do not think that we can expect that every European company will simply obtain an external credit rating. Getting an external credit rating is a complicated and expensive process, and most European corporates have no good use for it. Some member states have already developed clever solutions. The Banque de France, for example, makes available their own internal ratings that they have developed for collateral management purposes. That might be a good blueprint for other member states. In any case, it will be important that by 2032, there's a workable solution for the entire European Union, and the European Commission needs to keep an eye on that. The next point I want to mention is real estate financing. The second type of asset under scrutiny with the amendment of the CRR 3 is real estate, more specifically mortgages. The CRR differentiates quite granularly between different types of real estate loans, for example, commercial or residential real estate, or the exposure is backed by a constructed and already available property or an acquisition, construction, or land. Risk weights also differ relative to the exposure to value rates. In a sense, the new regime is not even more, it's very granular and less of a one-size-fits-all solution. In practice, this will mean, however, that risk weights for many types of real estate exposures will go up. This change is another example of the new Basel framework being a somewhat poor fit for the European market. After all, the changes do not seem to be motivated by particular problems in European real estate markets, but rather by the situation in other jurisdictions, such as the United States, that face much higher default rates on their residential properties. Once again, and to lessen the immediate impact, the regime includes the option for member states to make use of a transition period until 2033. This should at least grant some short-term relief. Next issue I want to mention is crypto assets. Lastly, there was one point that has gained in prominence over the recent months, which is the right regulatory treatment of crypto assets. We have all seen in the past months how volatile and sometimes even dangerous crypto assets can be, also from a financial stability perspective. Therefore, There's a strong case for shielding the regular banking world from the turmoil of the crypto world. The Basel Committee has already introduced a set of standards, which unfortunately came quite late for our legislative process. The Commission has therefore been tasked to submit a dedicated legislative proposal to the European Parliament and the Council by the 30th of June next year to introduce a dedicated prudential treatment for exposures to crypto assets. Up until that proposal makes it into law, there's a stopgap solution in the CRR. The transitional regime is based on EU's markets in crypto assets, which is the MiCA regulation framework, and comes with different capital requirements for different types of crypto assets and categorized by MiCA, by this marketing crypto assets legislation. The range of capital requirements is much higher than for the other traditional assets, namely 250% up to 1,250% for crypto assets such as Bitcoin. That essentially means that banks that want to hold Bitcoin have to hold €1 in reserve for every euro invested in Bitcoin, only to translate what 1,250% means. I believe that is a sensible in-between solution until we have the time to take a closer look at the full set of the Basel standards. So let me conclude. That was only a short overview over some of the most important aspects of the banking package. It is a several hundred pages document, so there's of course lots more in there, but I tried to keep it in short and concise. So what is the overall verdict on the CRR review? I have already indicated that I did not consider the original proposal coming from the Basel Committee a particularly good one for the European economy and the European banking sector. Keeping that in mind, I consider the agreement on the transposing on the CRR review to be quite satisfying. We managed to strike a good balance between sticking to the international rules and making smart adaptations to reflect European specificities. In some instances, however, we have only gained time. For example, when it comes to the treatment of unrated corporates, I mentioned it. With the transition regime, we have solved the problem for now, but not forever. So it will be paramount to make good use of the transition period. We also need to keep a close eye on how the Basel finalization package is implemented in jurisdictions outside the European Union. In the past, we have seen that some countries take a lot of leeway with the implementation, which could undermine the objectives of creating a level playing field. And this is an area we also need to keep an eye on and, if necessary, even adjust our own approach. So I leave you with that. Thank you very much. And of course, I'm happy to discuss it in all depths.
Thank you very much, Markus, for this opening speech and this explanation of various points within this package. We will discuss individually some of the points in more detail later on. Now I would like to hand over to Christian, maybe to share his view from a bank's perspective of how he sees or how banking industry, at least some parts, are seeing the package as it is about to be approved. Christian.
Thank you very much, Thomas, and thank you very much for this invitation. I think that Mr. Ferber has made an excellent introduction of the whole package. That this is all a challenge because, as we know, this is a very big package with several frameworks. Some of them are quite different in each other, and with new frameworks also in place. So thank you for that. I will make three general remarks, and then, as you said, Thomas, we are going to move more to the specifics. The first one is about timing. We are talking about finishing the Basel III. Usually it's used that, okay, it has been 16 years since the crisis, 20 years to get implemented. If you go to 32, it's going to be more years. But I think that we should keep in mind that this, at least for banks, this is not the end of the story. Not at all. This is quite just beginning because We have to implement these in parallel with other packages, for example, on the digital world and the ESG world, also huge packages. But more importantly, there are a lot of technical development to be made, particularly from the EBA. The EBA have 140 mandates, okay, 140. This involves regulatory technical standards that are 60, okay, 60, guidelines that are 29, reports on opinion 37, and other operational products that are going to be 14. So as usually said, the devil is in the details, and and we really know that in a complex package in prudential policy at the Basel, these regulatory technical standards and guidelines are going to be key to the effectiveness of the whole package, and also to the fact that it's going to be to the impact, sorry, that they're going to have on banks. So this is not the end for, at least for banks. We have this technical development in 4 years. There are going to be 4 phases that go to 2023 to 2028. It's going to be during the same transitional period that Mr. Ferber mentioned. That is going to be quite an effort, not only for the authorities at the EBA, but also for the banks. Because it's going to be in a quite short period of time. So, and then once you have the regulatory technical standard, we don't have to forget that we have supervision. And supervision is also in charge of applying these new tools and having regular reviews. And it's also is going to be a challenge, and also a new responsibility for banks, and also for the supervisors. So I can hardly say that this is the end of the story. It is going to take longer time. And I think that it's going to be a good opportunity, as also mentioned, to fine-tune, to adjust, and to don't deviate from the agreements. As it was mentioned, we know that the European implementation of the Basel has been a compromise. There has been a lot of discussion, and I think that the regulatory technical standard and all the technical development should be faithful to that compromise. My second remark is about the other components that were included in the package. It was mentioned that there was some ESG component, that there was also some discussion on crypto asset, there was also some discussion on the macroprudential policies. Here, what I would say that the reflection that I have is not all is capital and not all is liquidity regulatory standards in terms of banking regulation. I think that it's going to be good if we implement Basel faithfully, and faithfully with the compromise achieved in Europe. But we also are conscious that for the new risks, particularly on the digital world or on the sustainability ESG world, we might need other tools other than capital and liquidity. So far, the approach seems to be always more capital or more liquidity, and I understand the reason for that. Look into the last crisis, look into the history, for some particular traditional risks as credit risk. But if I see to these other new risks, I will say that we are going to need more qualitative approaches, more based on supervision, and particularly based on close collaboration with the sector through codes of conduct or best practices. Why? Because these are new risks for new technology, for example, that are changing every month. For example, now we are thinking on artificial intelligence. This is changing every month. So if we want to do the same that we made with Basel, I think that is going to be much more difficult to achieve. Final remark: what could help to reduce and to help banks to implement and to help authorities to monitor and to supervise these tools? I think that the risk-based approach is going to help a lot to achieve proportionality in the requirement, to don't create extra burden for the sector and also for authority and for regulators. And I think that there is key to assess the materiality of some of the risk. The materiality in terms of individual bank, but also how the risk of the individual bank contributes to the system. So that's what we are seeing, is that sometimes some risks that are specific, relevant, and material for some kind of banks or some particular markets, then the assessment and the requirement are extended to all banks. banks, with disregard if this is a material risk or not. So this is creating, I know what it is said, it is the motivation for that, but this is creating some, I would say, extra efforts for supervisors and also for banks that could be devoted to other risks and could be devoted to other activities that could be much more profitable for the whole stability of the system and also for the economy. That were my 3 remarks. Thank you, and I'm happy to continue with the more specific questions.
Thanks very much, Christian. Then I would hand over then to Bart, who's looking into this from a practical but also from an academic perspective. Bart, over to you.
Yeah, thank you, Mr. Chairman. The subject of today's policy debate would warrant a much longer discussion than we are able to do this afternoon. The hundreds of pages of amendments to both the CRR and the CRD will make changes to numerous issues. The recent developments in the banking sector, firstly looking at the issues in the United States and looking at Credit Suisse. Secondly, at the impact of climate change also on the financial sector. The recently agreed amendments and to be agreed amendments already appear outdated, and there will be most likely calls to think about CRR4 and CRD7. And I will be interested to hear from Markus Ferber a reflection on how the European legislator views yet another very substantial investment in time, manpower, to flesh out these future amendment projects, and in particular the extent to which there will be sufficient political support to move the amendments quickly enough through the legislative process. And another point I wanted to raise with Mr. Ferber is the issue of proportionality. Now, thanks to Parliament's efforts, we shouldn't forget, a regime for small, non-complex banks for the net stable funding ratio has emerged. But this innovation in banking supervision in Europe, by introducing a bifurcated system, one set of rules for the large banks and one set for the smaller banks, has not been followed up in terms of substantive law standards, except for some adjustments to the disclosure rules. Now, there's a reason to suppose that a uniform application of certain new rules in CRR3, and to me in particularly the new operational risk management rules stand out, is going to impose disproportionate burden on many of the smaller banks, in addition to all the adjustments that need to be made for the application of the revised standardized approach rules for credit risk. And the example of the new risk weighting approach for corporate lending is a nice example in real estate as well. So I would also be very much interested to learn from the views of Mr. Ferber on that one. And finally, I wanted to introduce a rather more sensitive point, and that concerns the design of the single rulebook. It is no secret that the European Commission had a strong preference in 2013 for the single rulebook for banks to also to be comprehensive, including the many rules now contained at directive level, the CRD. Would Mr. Ferber also like to discuss with us the advantages and the disadvantages of this two-track system of regulation for the banking sector, which I just wanted to throw about in the camp by saying that that system may possibly stand in the way of even more effective supervision in the single supervisory mechanism. So there seems to be a good reason to leave the path of dual regulation and directive perhaps in the future, question mark. And I would like to leave it with this, because I think I will be very interested to listen to the feedback from Mr. Ferber. Thanks, everybody.
So thanks very much, Bart. So there have already been a lot of questions as part of these opening statements. Markus, you can already reply to them right now, or we can also go through some more general questions at the beginning, however you want to play it. I leave this to you.
I'm in your hands, Thomas. So
yeah, but maybe
I think it's appropriate.
Bart directly asked some questions to you. I mean, I would certainly add one point. This is a question I thought about when you look into this whole matter, is certainly the level playing field issue. I mean, you have been also very critical about the original Basel document from 2017. And in other jurisdictions, namely the US, I mean, there has been a big debate about the implementation of this into national rules. I mean, I even read that the banking lobby even issued commercials in football games against the implementation of Basel, which I've never heard of, that you run commercials in football games for a banking regulation. So there is a really strong push against that. And Jay Powell has already said there will be some review of the original draft from the Fed. So maybe also in line with what you said and what Bart is mentioning, level playing field issues. I mean, there are some provisions which would enable the Commission to, via delegated acts, to make amendments and specifically related to market risk. But how do you see the whole thing if it's completely unknown what is the outcome in the US when it comes to the implementation of that right now? And maybe also you can answer some of the questions that Bart has been raising.
Yeah, I will start with the first question of because, of course, from 2017 till today, we have seen that Basel made a lot of new proposals which are not implemented yet. The only one we took up a little bit and asking after this transition regime for a special regulation beyond the MiCA was dealing with crypto assets, which is a Basel paper as well. We got some other special papers from Basel during the negotiations. Some of them we tried to implement as well. Some of them we refused to implement. But in general, that shows that on the one hand, Basel has to improve its work. If they start now with nitty-gritty papers on an annual or biannual phase or period, I think neither the way of transposing it in the US or the way transposing it in the European Union is sufficient. So we do it by legislation. Americans more do it by implementation via SEC and CFTC, via the authorities, and not with Senate legislation. But even for that, you need empowerment from a Senate that the authorities can do that. And therefore, we really have to rethink firstly Basel, and as I said, for us Europeans as well, how we present ourselves in Basel, because I had really the feeling the 2017 result was more an US solution than a European solution, and addressing a lot of problems to us, but not to them. But even though we see that they have problems. And of course, we have to be aware that we are in a campaign year on US level. So CRR, CRD did not play a role now, and as we are going to vote it tomorrow, it will not play a role in the campaign for the European elections, but it plays a role in the US election campaign, and the president and the candidate from the Republicans have made statements about what to do. And that is the last thing I want to say. We have to keep these things out of campaign. Stability of the banking sector should be a common goal, and how to achieve it should be a proper discussion. But I think it's not an issue for campaigning, and I couldn't agree more. To have advertisements for that is maybe good for the TV industry, but it's not very helpful, because the normal people on the street, they want to have stable banks. However, we are able to manage that to deliver good services. Our real economy wants to have stable financial sector, which is delivering good services, and that is what we should concentrate on. So after having that said, I forgot a little bit your question, Thomas. So sorry if you could give
No,
me a hint.
my question was more a general one. What are we going to do if there's some fundamental difference now in terms of what is coming out of the US proposal? So in terms of level playing field, yeah.
Yeah, we have to be aware of that, as we have a lot of problems. If I look at where the IPOs at the moment are taking place, it's not Europe, it's not London, it's New York. And therefore we have to find answers. Only to mention one thing, and if I look to the profitability of the banking sector or the financial sector in the US in comparison to European Union, there's a wide gap as well. And the number 3 is, of course, the how to say it in neutral words, the non-possibility to create European banks. Yeah, according to our way of dealing with all these issues, we have still a very fragmented market, and this market, neither on the real economy side nor on the banking side, will create champions who can play in the World League. Maybe we have good champions for Europe, but that is not enough. We need on the real economy side as well as on the financial side to finance these companies, European champions who can compete in the world markets. And that is what we should achieve when we speak about Capital Markets Union. And I think the approach we did in the last 10 years to make Capital Markets Union via harmonization of products will not be sufficient. We have to think on infrastructure. We have to think on cross-border possibilities, especially in taxation and in insolvency law. Otherwise, we will fail. And then we are a nice nitty-gritty market with wonderful rules, but not creating added value for our real economy.
Thanks very much. Maybe Bart, you also had 2 or 3 points you directed to Markus. Maybe you want to
talk about a little bit, indeed, apart from the points that Mr. Ferber already mentioned. One of the other remarkable things that happened in the Basel Committee was when the previous president came into force. He sent some messages to Basel that the Basel Committee would not be permitted, at least that the US would not be cooperating with any analysis of climate change risk. Yeah? So basically the Basel Committee only stepped up 2 years ago after the new president came into force. And this results into horrible delays in the analysis necessary for to address particularly quantitative capital requirements for the climate change risk. And this ends up basically also in troubles in Europe, because the European banking authorities now waiting until Basel has come up with the framework. And Europe cannot go on its own way in this respect. But on the other hand, we're quite troubled with this phenomenon. But in any event, these new standards, so the Basel V, if I may make a bit of a joke, will then need to be processed in CRR 4. And in addition to that, we also may have to change some rules with respect to liquidity management in view of the experiences now we've seen with Credit Suisse and with the US banks, that it might end up in some changes to liquidity coverage ratio rules. And on that note, in addition to the other projects, it might end up in quite, again, a very large legislative project. My question to Mr. Ferber was, how does he basically, there's some sort of urgency with these topics to regulate them, and what is his anticipated view on how does he anticipate that will there be sufficient political support to get this through Parliament in a quick way? Yeah, that's a question I hopefully am allowed to ask a politician.
Of course, you are allowed, but I can only tell you that this is the last session. Then we will have the votes from the 6th to the 9th of June. We will have our first plenary for the new elected parliament from the 16th of July onwards. And on the 18th of July, it is foreseen that or the 19th of July is foreseen that we establish the committees. And then we are only workable again. And that means if there are quick adjustments necessary, they can be done, but honestly, earliest in September, the parliament is ready to work again. And then, of course, things can only happen when Commission makes a proposal. Therefore, Commission has to consult in the forehand EBI, the European Banking Authority, how to transpose that. And of course, we have to be aware that we are then in a time frame where most probably the Council has not yet agreed on the CRR, CRD, on the final Basel III finalization, as they wait for the last language version before they vote. And we have to avoid that we create a mess for the banking industry, which rule applies when. And even for the surveillance authority, it will become difficult. And therefore, we really have to rethink how we can manage that in the future to have these fast-track procedures in a proper way, on the one hand, in a democratic way, on the other hand, but in a fast way as well, without disturbing the implementation of all these things which are in the pipeline already. And that is, of course, the big package we are voting on tomorrow.
Very good. Thanks so much.
And perhaps one further reflection on the proportionality question also raised by I would very much be in favor that Europe would proceed with enacting a bifurcated banking law. So as the US has and as Japan has and many other jurisdictions, a regime for smaller, medium-sized banks and one for the larger banks justifies tougher regulation. Now, with the net stable funding ratio, the European Parliament already created and shaped on that particular topic this bifurcated regime. For small non-complex banks, basically mitigated rules apply, and for the large banks, of course, the full-fledged Basel rules. Now, the whole, but apart from the FR, we haven't seen too much more work on proportionality regime and the application of the entire banking law to all the banks, no matter their complexity, no matter their size, and so forth. So, would you be willing to reflect a little bit on the idea that I'm floating, that it might be time for Europe also to start looking at sort of bifurcated regime, one for the larger systemic important banks and one for small and medium-sized banks?
Yeah, if I may, Thomas, as I was introduced, being responsible in the parliament as well for small, medium-sized enterprises, of course, you are running through open doors, as I was one of those who helped to invent in the last legislative period these, I use the old world small banking box, where we tried to solve or address some problems. But honestly, the approach to have a single rule book and then to say proportionality means that not 100% of these obligations have to be fulfilled by every bank is not a helpful tool. So a single rule book minus as a proportionality tool is not helpful. I look to the Swiss model, who has, for example, a small banking regulation for those who have only activities internally in Switzerland. and have a very harsh regime for those with cross-border activities. And the main approach is that those, who was it? Who was the phrase? I loved it. I heard it in Zurich, and they told me, if you are flying over the mountains and no one takes so much care on you, you have to fly a little bit higher, which means the small banks have a little bit higher capital requirements, and that's it. But then you don't have to take care for every second on them. I like this picture. It was, if you are in Switzerland, you see the mountains around you, you can imagine what it means to have only a few rules for those small banks with no cross-border activities. I think that is the main tool, and I think we made a good definition already in the existing CRR in the small banking box for those banks with higher, a little bit higher capital requirements, and that's it. Could be a helpful tool. But then we have to address a lot of problems in the banking union issue as well, because I cannot say I have on the one column in the banking union only those who are supervised by ECB. I have in the second pillar only those who are directly linked to the single resolution mechanism, and then I have all of the banks in the deposit guarantee scheme. Therefore, we have to find a solution as well. What does it mean to have a banking union? So there are a lot of questions to be answered in the forehand before we start that. And even that is now more seriously discussed in the Commission, as member states and the Commission and even the authorities, national competent authorities, see that we will not be able to address all these issues for every single financial institutions. We need more proportionality, and only to say single rule book minus is proportionality is not sufficient and is not very helpful tool. I couldn't agree more than we have to invent something new on that.
It's not easy, I agree, because in the end, even global banks sometimes compete with the very small ones when it comes to specific businesses, and to have a fair level of regulation in that regard is probably not the easiest solution. Maybe one point I would like to add when it comes to regulation, because I mean the whole Basel framework, which we are now talking about, is to some extent even going back to the financial crisis and some issues around that one. And we have seen last year in the US banks failing essentially also because of liquidity issues, a fast withdrawal of liquidity when it comes to SVB or Signature Bank, where you could then also raise the question whether the liquidity ratios, which have been established in the aftermath of the global financial crisis, so LCR and SFR, in a time when liquidity can be withdrawn within such a short time period, whether they are still adequate or whether there needs to be some adjustments in that regard as well. I would be interested what you think about that. And also to Christian and to Bart, of course. But maybe Markus, you want to start?
Yeah, sometimes we are victims of our own regulation, because if you follow everything, you should invest in government bonds to be fulfill all the liquidity requirements. But if you are in a period of increasing interest rates and you have such a capital flow as SVB had, you are punished by that, which was identified as a stable solution, and therefore I think other tools have to come into place as well. If you have so high exposures as SVB had on short-term money, you have to find other management tools, and the authorities should have care on that as well. But SVB was, according to the US proportionality system, not in the higher strength of critical banks. I do not know an answer whether a general rule can deal with that, because if I look to the European banking sector, of course, we have some losses, or had some losses in this time period, as well as the secondary markets for governmental bonds with low interest rates went down, and therefore you have to recalculate your assets. But if you keep the papers till maturity, nothing happens. And therefore you should avoid to create an instability where no instability is directly happening. And therefore, I think you have to take more look on the exposures on short term on the deposits than on the assets the bank is holding. But to put that in a general rule is very difficult. I think that is something which from the banking sector itself, from the banks have to be careful on that, and the national competent authorities, or for the SSM banks, ECB has to have a look on that as well. But as long as the exposures on the deposit side are not as crucial as they've been at SVB, you have only this problem till the paper arrives maturity, and therefore it's more a booking issue than really a problem for the stability of the banking sector.
Thanks very much. Christian, maybe
Yeah, thank you. Okay, on the liquidity, just one thought on my side. I think that we are missing one dimension of the resilience that the new liquidity standards, both the LCR and the NSFR, has bring into the system. That is the ex-ante resilience, because when with the true standard, what you are putting a limit to the amount of the liquidity and maturity transformation that banks are doing. Okay, you are preventing and you are affecting, okay, how much liquidity and maturity transformation banks are doing. And this is, let's say, this is ex-ante resilience, and then you have the export resilience, that is the capacity that is the liquidity, the LCRs particularly give you to absorb losses, liquidity losses in case of stress. I wouldn't disregard the first one, the first source of resilience, because it has been very important and already an achievement in Europe. But by the same reason, this is a very, very particular standard, particularly the NSFR, because it's the only regulatory tool, the only regulatory standard that it is combining all the assets in terms of liquidity and all the liabilities in terms of their stability. This is why this is such a powerful tool, but also we have to be very, very careful with the calibration. And this is why perhaps this question that Mr. Ferber posed, that perhaps one standard fits all arise, because it is let's say, it's a very comprehensive tool, very powerful, by the same reason that this is affecting different banks in different manner. That's my first thought. The second thought is that on liquidity, if we want to kill the liquidity risk, which has one tool, probably that is not going to work. Okay, because the liquidity risk has been at the heart of the financial intermediation since ages. There is a key element in the whole map, that is the central bank role as a liquidity provider of last resort, as a liquidity provider in different circumstances. And in that sense, I think that there are some work to do, perhaps to improve some of the tools that we have. The LCR perhaps could take into account some kind of collateral of assets that we banks have and can eventually bring to the ECB, okay, in case of stress. The spirit of the standard, the liquidity standard, has been to get market sources of liquidity. Okay, you have to be able to bring this asset to the market with a low haircut, with a low impact, or a low impact on prices. But we cannot disregard that in particular scenario, the role of the central bank is going to be very, very important, and is going to still be there. So I think that perhaps some refinement on that could be useful. But as I said, these tools are targeting liquidity transformation that is at the heart of the financial intermediation. So we have to be super careful with the calibration to not affect financial intermediation. And then I have just a follow-up question for Mr. Ferber, continuing on the proportionality issue. Perhaps it's a broader question, but I see proportionality as just one element of a much bigger issue, that is competitiveness of the banking sector. So my general question for Mr. Ferber is, what could be done, or what other perspective for the next mandate of the Parliament and the Commission, for the next legislature, for regulation to be more focused on competitiveness, not to perhaps to support competitiveness. I'm not saying to promote competitiveness, because perhaps that's not the role of regulation, but to support, to help ensure the banks are competitive because they are profitable, We know that cost of equity is a big source of profitability and might be also playing a role with other factors. How we shape that kind of regulation where we pass from one paradigm, one that was resilience. I think that a lot has been done on that front, and now perhaps we need to pass to other paradigm where the focus or the onus could be more focused on competitiveness. Would that be possible? That's my question.
Thomas, maybe I can close the discussion on liquidity because I have some thoughts, and then indeed look at the paradigm shift. So with respect to liquidity and solutions, well, to use a little bit of a US expression, don't fix it, it ain't broken. The Basel Committee basically had established its terminal report in October 2023 to evaluate basically what went wrong in the US and what went wrong with Credit Suisse. And there basically it is common understanding that the Basel Committee also said something like, well, the way the Europeans basically evolved the law, so after the 2010 LCR rules and the NSFR rules, we have created much more, if you like, monitoring ex ante monitoring, indeed to look at resilience and the capabilities of banks basically to address liquidity shocks, so that these further adjustments to the liquidity regime, there basically the Basel Committee has said in October 2023 that it is likely that their recommendations for improvement of the standards will follow the European example, if you like, and on that note, basically, probably there will no need to change too much in the European environment, and it is with that in mind that ECB. In the aftermath of the problems with Credit Suisse, quite confidently could confirm that the European banking sector is much more resilient than perhaps is the case in other jurisdictions. So we have seen some examples with larger banks of liquidity outflows quite drastically. If that would have happened before it has changed its regime, then we would probably be in a little bit more troubles. But it appears that even that large bank that had suffered a little bit from liquidity outflows was fairly resilient because of the fact that the rules worked and the monitoring worked in that respect. So this is just a reflection I wanted to give.
Thanks so much, Bart. And then almost at the end anyway, maybe Markus to close it on some of the points that Christian has been raising.
Yeah, it's a very big issue, and sorry that the time is running out, but competitiveness will be one of the major headlines for the next legislative term, and it has to be. And if you look to the conclusions of the European Council last week, that was even addressed even for the financial sector. And as I said even before to Bart, on the one hand, we need really European banks for European companies. If we want to have a strong telecommunication sector, we need a new legislation or regulation how we can really come over this reflection on 27 member states markets to a single market. And therefore we need larger companies, and they need a larger financial sector as well. So we need more cross-border banks which are really delivering these financial services to these kind of companies. And on the other hand, we need proportionality for those banks who are really dealing only on a regional or national market, have no cross-border activity, do the good old boring finance model and finance business. And therefore we need a special kind of legislation. Competitiveness is not an issue for legislation. That is issue for setting a frame. Yeah, and that means, of course, to reduce bureaucratic burdens. We have adopted now this single access point. The data are only transferred to one point where all the authorities can have a look on and take out what they need. To mention one example, we have these activities from the Commission to reduce bureaucratic burden in general, especially reporting obligations, which is a huge issue for our banking sector, to get rid of that. And I think that are the things we can do in the first run for achieving competitiveness. But secondly, we really have to invent a single market for the financial sector. And that means as well a single market for our energy sector, for our telecommunications sector. We need cross-border net infrastructure for electricity and hydrogen, all of this stuff. And therefore, we need companies who can construct it, and we need a financial sector who is able to finance that. And that creates competitiveness. I think we need a new approach, as the Cicchini report and the white book from Jacques Delors has been in the late 80s, something like that now, as a new push for the single market, really to achieve this competitiveness and to get rid of a lot of problems. I think it's now time to deliver in that area, and that should be, according to my understanding, the translation of the wording competitiveness in the financial sector.
Thank you very much, Markus. It were very good closing words and closing remarks as well. We're now at the end of this event. So thank you very much to all of you for participating. Markus, Bart, and Christian for your remarks in that regard. I have the impression, I mean, banking regulation is a very fluid piece of regulation. I have the impression that there will be additional changes in the future, obviously not too far, I would even guess. But let's see, we're going to follow this here also in the EBI. And I would like to thank also the audience for participating, and we'll close this event. So thanks very much and goodbye.